Welcome to The Upside, a show that helps you make sense of your financial life. We'll go beyond the headlines, bringing in experts from all over the financial world, from portfolio managers to tax experts and everyone in between. We want to help you make the most of your money and your life. Welcome to the show. I'm your host, Emily Enenwevo. Today, we want to help you navigate the ETF space by focusing on one major investment strategy that could help diversify your portfolio, factor-based investing. We'll break down the basics, what types of ETF factors are out there, and how you can use them strategically to increase your return. To help guide us through this topic is Fidelity Canada's ETF strategist, Katrina Wilson. Katrina uses her tactical investment expertise to help research and design ETF portfolios for Fidelity. Katrina, welcome to the show. So happy you can join me today.
Thanks, Emily. Thanks for having me.
Happy to have you here and dive into this topic. It's all about factor-based investing. So break it down for me. Break down the basics for me. What is factor-based investing and how does it work exactly?
So factor-based investing is going to have a lot of common elements to passive investing. So passive investing being tracking any kind of market cap weighted index. That might be the S&P 500, it might be the TSX. The difference is instead of looking at market cap weighting to determine whether a stock should be in a portfolio or even what allocation should be given to that stock, we look at different investment criteria. So let me give you an example. If we're looking at the S&P 500, if Apple has a larger market cap than Exxon, we're going to see a bigger allocation to Apple in that portfolio than Exxon. Now, the only merit or the only criteria we're looking at in this instance is the market cap weighting of that stock. Now, take a factor index or a factor strategy, for example, look at dividends. Instead of looking at one company being larger than another and therefore earning a larger position in a portfolio, for the dividend factor, what we look at is the dividend yield. So you might actually see a company that has a smaller market cap have a bigger weighting in a portfolio because it's generating higher income for the clients. So really, if we think about factors, we're looking at identifying or using different criteria in order to really create a customized experience for investors and look at, instead of just looking at market cap weighting, look at different investment metrics.
Love it. Great explanation. And I really enjoy having you on the show. You've been on it before because you're really great at breaking down the basic terms and, themes into very understandable, language. And for first-time investors watching, Katrina, how does this type of investment add to one's portfolio, would you say?
So I think there's really two ways, and thank you for that, by the way. I'm thrilled to be here. And I think there's really two ways that we can think about factors and how they can really increase the overall risk return profile for investors. Number one is looking at, the objective to outperform the market. So we've been accustomed to looking at these market cap weighted indices as being the standard, the gold standard across, like I said, S&P 500 for the US, really being that gold standard for investment returns on the US stock market. What factors can do is give you different ways in order to really give you a unique investment experience and really with the objective of outperforming these passive indices. So number one is just aiming to have a more attractive risk return profile. But number two is really just giving investors the ability to customize their investment experience. And something that I heard that really resonated with me is everyone has different spending patterns. You might have two people going to shop for cars on the same day, and they might be looking at, different criteria. They might have different budgets. There's different things they're trying to get out of those cars. There's really different emotion and different process that they take into account when they're looking to buy those cars. Investing should be the same. So what factors do is it can really help investors be more engaged and feel more in control of the way that they're investing. Instead of the one-size-fits-all market cap weighting, people can really get a better understanding of why certain factors might choose one company or one stock over another, and really help investors feel as though the way that they're spending or investing in the stock market can really align with how they're spending in other areas of their life as well, and just really feel more in control of what their investment experience is.
Absolutely. Great way to put it. Now, let's get into the crux of the conversation because I know you wanted to go over 3 ETF factors and specifically describe their characteristics to help us understand how these factors fit with different types of investors, let's say. So let's go through them one by one. Katrina, what's the first one you'd like to discuss?
Sure. So one of them that we're, hearing a lot about lately is momentum. So momentum is, and if we think about sort of how someone might be spending in their real life or using some real life analogies, think about the investor or the shopper that's really excited about the newest iPhone. And so what momentum's doing is it might not follow a specific sector, it might not follow a specific attribute. Really what it's doing is what's working right now. And so let's use a sports analogy. Let's say, you've been following one sports team for the whole season and all of a sudden they're out of the playoffs. Now, you might not know what team to go for right away, but you watch the next season or the next series and all of a sudden a new team really starts to catch your attention. They're picking up steam and, you feel as though this is the team that you want to get behind. That's momentum. So when momentum really works and the type of investor that will resonate with it is those that are really looking for that next trade, that next idea, the next thing that they think is going to work. When does it not work? It doesn't work through a transition. Or I shouldn't say when it doesn't work, but what the risk involved with momentum is when there's a shift or when there's really a transition point. So using that sports analogy is if your team loses, it might take you a couple games, a couple series, or, a few days to identify what your next team is, and then you're going to get on board with that next team. So that's really what momentum is doing. It's shifting across the business cycle. It's constantly changing and really looking for what's working, and let's get behind that new theme.
Hey, great. And what's the second ETF factor that you want to go over?
So second one would be value. It's a term that we hear a lot in the investment industry, and sometimes it's not always broken down. So let's spend a few minutes. What is value? We think about the discount shopper, but in investments, how do you measure, whether one stock's cheap relative to another? So in real estate, we look at two houses costing the same, and they might have different square footage. So there's obviously a lot of other criteria that we look at, but usually we break down the cost of a house or a condo as price per square foot. In the investment industry, when we look at valuation, what we look at is the price of the stock relative to the dollar of earnings. So if you have two stocks trading at $100, one of them has had, $2 of earnings for every security or share outstanding, and one has, $1 of earnings for every share outstanding. One of the stocks would be double the price or double the valuation of the other. So really what value is looking at is, what stocks out there, what sectors out there are trading at a discount relative to peers. Now, this will really resonate well with shoppers that are going to be, that discount shopper in two ways. One is you might have a budget and you're not willing to adjust that budget. So if we look at what's happened over the last few years, the value factor has lagged, and a big part of that is because it hasn't been investing in technology. Technology stocks tend to trade at a premium, but we see a lot of shoppers out there, we see a lot of investors that are okay not paying for a premium for whether it be a pair of jeans, the new iPhone, or a stock. They're really looking at what they feel is the fair price, and they're going to invest their money in, what they feel they're getting the best bang for their buck. So that would really be the value factor, is looking at what stocks out there trading on, if you're looking at the US market and within the S&P 500, or trading at a discount relative to peers, and really looking at putting, investing in those companies that are trading more attractively.
Okay, understood, and great way to put it. I can really get behind the whole value and discount shopping because that's truly who I am. So always looking for the good sales and, like you said, setting a budget there. What's the next ETF factor you want to go over, Katrina?
So the next one would be quality, and that's something that we hear the word quality and can't always, wrap our head around what that means. And what I would say is quality is the cautious shopper. So if we think of momentum being, open to buying the newest iPhone, you're excited about the new iPhone coming out, you're really comfortable spending that amount of money. Maybe the value shopper is looking at another brand of iPhone that they feel is, lower cost but giving you similar usage. And then quality would be the shopper who's very cautious. They're not necessarily as focused on what your budget is or what you're going to spend, but you're really looking at what's the return going to be. You spend a lot of time, you probably have a big process when you look at, I'm going to buy a new phone or I'm going to buy a new car, you almost have your checklist. So from an investment standpoint, what quality looks at is really trying to identify companies where the management team is more prudent, more cautious, really taking into account if we have, we talked about earnings, if we have $2 of earnings a share this year, how are we going to allocate that to really maximize our returns next year? And they're looking at, whether it's more effective to pay it out in dividends for our shareholders. Maybe it's looking at, reinvesting in the company in R&D. So when we talk about capital allocation, that's really what we're trying to identify. The quality would really be that cautious shopper, or the sort of process-oriented shopper tends to do really well in a recession. So from an investment management, those that are, especially if you're thinking about, prudent management teams or prudent shoppers, think about companies that in a recession tend to be more resilient than peers because of those management teams being very careful as it relates to that capital allocation. But also really does tend to keep up with the market. So momentum, like I said, is going to be more of that high flyer, looking for that next trade, buying that brand new iPhone. But quality might be the buying, last season's iPhone if you still feel as though it is, going to get you all the benefits that the new iPhone's going to get, and you feel a little bit more comfortable with the spend on that phone. So really momentum being that, bandwagon or being looking for that next iPhone, value really being that discount shopper, and then quality being more the prudent shopper or process, putting a process in place with your spends.
And how important is that quality factor these days with all the market fluctuations when you talked about, how quality sort of goes with what's, going on right now. And that leads me to my next question, Katrina. Key risks investors should be aware of when using this strategy. What should they keep in mind, like I said, with fluctuating markets similar to what's happening right now during this health crisis?
So really, if we think about factors as one theme and, incorporating factors, like I said, whatever factor really resonates with you and your traditional spending patterns, what to consider is typically factors, whether it's value, quality, there's going to be stages of the cycle where you're more likely to outperform the passive indices. So if you use the S&P 500 of your index, there's periods like we talked about quality in a recession. Quality tends to outperform the S&P 500 in a drawdown. Whereas when you're in early recovery, it can lag. And so really I'd say the key risk or things for investors to consider is what's most important to you. And, where are we in the cycle? And how active and engaged do you want to be? Because, at some stages of the cycle, like I mentioned, you might risk underperforming the index. So I think understanding some factors might underperform in volatility. And so if you're more sensitive to losses, then looking at a factor like quality that tends to perform better in the drawdown, but then the risk is that in that recovery, you could lag the broad market. So I'd say consideration or key consideration when looking at factors is not only looking at what strategy resonates with you from a standpoint of, investment psychology, but also thinking about what's most important to you and at what stage of the cycle do some factors tend to respond differently, and what is your investment objective?
No, absolutely. And so much excellent information there. So I guess my last question then is any important takeaways for investors who are considering this approach for the first time?
Absolutely. I'd say number one is don't think that investing has to be a one size fits all. Everybody's different in terms of what your investment objectives are. Everyone's different in terms of how you feel comfortable spending your money. And like I said, investing in the stock market shouldn't be any different. So my number one advice would be, understand the factors from a standpoint of how they respond in different market environments, but make sure that you're comfortable with, every dollar you're putting into a certain factor. Are you comfortable with how that money's being allocated? And really feel like you can be more engaged with the security selection process, and really that it aligns with what your objectives are, as well as, like I said, your traditional spending patterns. So don't feel like investing has to be a one size fits all. Make sure you're engaged and comfortable with the way that your money's being invested.
Such an important message there about, not one size fits all. And investing is a long-term process, right? It's a learning process. And I love it when you're on the show because, like I said, you break it down to the basics. You make it understandable. I love all the shopping examples and analogies you gave. So Katrina, thank you so much for joining me today. Really appreciate it.
Thanks for having me, Emily.
And thank you for watching The Upside. If you like this episode, be sure to give it a thumbs up. And please subscribe to Fidelity Canada's YouTube channel for more great financial content. And please feel free to leave comments below on what other topics and guests you'd like to see on future episodes. Thank you so much for watching, and I'll see you next time on The Upside.